Focus now to emerging markets, where emerging market central bankers are getting rather nervous about their plunging currencies. Wray, he is a chief economist at Evergreen GaveKal, joins us now to give us a little bit more context. Thank you so much for making the time to join us. Perhaps just give us firstly the key underlying reasons why we've been seeing the negative trajectory or the weakness on the part of emerging market currencies.
Sure. So emerging market growth has been supported really over the past couple of decades by an over-accommodated Federal Reserve and a Chinese investment boom that really accelerated after the global financial crisis. Both of those supports are now being withdrawn. It's something we call the dual taper. So with the Chinese investment boom running out of steam, getting to a point where it can't sustain this level of credit growth, China's investment demand is falling, and it's having a big impact on commodities. Simultaneously, you're seeing the Federal Reserve start to withdraw its overly accommodative measures over the years. You've seen a taper in sentiment, which began with a taper tantrum in May of 2013. You've seen a taper in its quantitative easing program to zero, and now they're looking at raising interest rates. There is a lot of capital that's gotten pumped out into the emerging markets that were supported in many cases by commodity demand that was frankly unsustainable. And now we're seeing the flip side of that. So unfortunately, even though you've seen a lot of emerging market currencies declining with capital flows trickling out since 2011, I'm afraid their problems are just beginning.
When you look at commodity cycles, I've gone through plenty. It goes up, it goes down. You know, whenever it's at the bottom, you can never see what's going to turn it up again. And whenever it's at the top, you can never see what's going to turn it down. The big problem to me is oversupply. And I would say, I don't know, 30% of world commodity production is now losing money every day. Surely at some stage, production is just going to be cut, or maybe it's already even started. What's your view on that?
I agree with that. And I think we are starting to see production cuts at least being planned. I think we'll see more of that next year, particularly in the oil market. And you do have a supply glut in oil, for example, from the U.S. shale boom that's likely going to be exacerbated by the Iran deal that's pending. So supply issues are a problem. And I think over time, supply will heal. Supply will fall. You'll see demand and supply come back into balance, and commodity prices will start to go up again. The question is when. You know, we've seen this tremendous commodity super cycle that's happened over the course of decades. And with China slowing, I don't see an economy set to pick that up. India's industrialization is still a ways away from being able to do that. Maybe China's One Belt, One Road initiative could be that new source of demand. But in the interim period, over the shorter term, the next 6 months, the next 12 months, we have a real problem, and that's the demand side. You know, it looks like with emerging markets starting to come under fire, with the Federal Reserve moving toward tightening, it looks like you're on the edge of a series of crises. And I think it's important to look at it as a series of crises, not one big event. If a country like Turkey, South Africa, Brazil, Indonesia, Malaysia, Chile, if they fall into crisis and there's a significant amount of capital flight, so their currencies are falling versus the dollar gets stronger, that puts more downward pressure on commodities and puts more pressure on a whole new round of economies. I'm worried that that kind of pressure can cascade and create demand destruction like you saw in the Asian contagion in 1997. That led to bigger crises in Russia in 1998, the eventual fall of long-term capital management. So the supply glut will play out over time. Markets will normalize. But in the interim, I'm worried about a demand shock, and that could bring prices significantly lower.
How much of this is what we're seeing in terms of it being related to commodities, which is what we've spoken about thus far, versus structural weaknesses in these economies that make them even more vulnerable to global monetary policy moves?
Is absolutely fair. And I think in most cases, you do have profound structural weaknesses. But I would add that those structural weaknesses have been sort of papered over by easy access to ample capital flows from the developed world and by commodity demand that was unnaturally strong. As those forces are being taken away, or those supports are being taken away, it's revealing structural weakness. And I think what's also important is that with those supports over the past few years, you've had politicians in emerging markets that have not been forced to do the reforms that were so desperately needed. Now that structural weakness is being revealed, political dysfunction dysfunction is rising. And I think it's important to keep in mind that political dysfunction is both a cause and a consequence of FX crisis. So as now all this weakness is being revealed, as the flow dynamic globally is changing, as commodity prices and global trade demand fall, now we're in a situation where the politics in many countries are likely to get much worse. And that means for a lot of these emerging markets, they're at the relative beginning of a long, painful road. And it's important to keep that into account for viewers in South Africa. This is not a moral judgment by any means. It's an economic one. But South Africa has deserved a lot more capital flight than it's gotten in the past several years. The structural weakness and the structural problems have been profound. So South Africa didn't enjoy the credit miracle that Turkey or Brazil did, for example. But I'm afraid it's going to be on the receiving end of this significant fall.
With perhaps two economies that we can consider as problem children at this time, let's talk a little bit about Greece and a little bit about Puerto Rico in light of the default. Just give us a sense of what do you think is likely to unfold in those two economies, given the broader picture that you've just painted?
Sure. So I think it's important to keep in mind that Greece and Puerto Rico are in very different situations. Greece is a sovereign borrower that's been locked into a currency union with a stronger partner. It hasn't been able to get the relief it's needed. And yes, there's been a profound structural breakdown. The imposition of capital controls through the last negotiations destroyed that market. You can look at the most recent PMIs to the industrial havoc that's played out there. It's no surprise that Greece's stock market has plummeted when it's recently reopened. Portugal, on the other hand, is a municipal borrower. And like we've seen with Detroit in the United States over the past several years, municipal defaults can precede a very, very painful chapter for a lot of these regions. But we do have a central bank in the United States. We do have a fiscal transfer union that can provide relief to Puerto Rico if the powers that be decide that. That's a very largely political issue, and I'm not sure how it's going to go. What I point out, though, is that in Greece's case, unless there is a move to a fiscal union or unless they leave the European Union, there really isn't an avenue for Greece to improve except on this very low value base. It does seem like from a value perspective, at some point, Greece is going to be a buy just on stability that looks like it's in place for now, but it's very uncertain. And I think the important thing to keep in mind here, a lot of people look at Europe as the big problem. That's where all the attention has been fixed. But the imbalances in Europe that we're looking at today and were clear back in 2007, I think that's the kind of imbalance you're seeing in emerging markets, the threat to the world that has not been papered over. And it's a clear and present danger to the global economy.
Well, thank you so much for those insights. That's Wray, the chief economist at Evergreen GaveKal.